Why is that the case? That's the case because investor A just bought their funds on a rising market. And so their $600, their $100 every month didn't go as far. It wasn't able to buy as many shares. Month one, 10 shares, 12, 14, 16, 18, 20. It wasn't able to buy that many shares because $100 can only go so long, so far. But the systematic investor was able to take advantage of fluctuation that so when the market went down or the fluctuating market, and so when the market went down, they actually bought the market on shares. So here's the share per price, but then this is how many shares they actually bought. 10 in the first month, 14.29, 25, 50, 60, 16.67, and back to 10. So here, when the market returns, and listen, here's the rule of thumb: unless the country blows up, Jesus, please, unless the country blows up, Lord, don't do it. Not yet. Yeah, but you can. You come back when you want to. Come back soon, Lord. But if our country don't blow up, right, the market always returns. It always goes back, right? And so when that's the case, we look at the fact that the investor B has more shares, has more money in the market because they invested in a fluctuating market. So stop letting the market scare you, especially if you're a systematic investor. If you have a lump sum, talk to me. We got to put some protections out there, right? If you've accumulated some funds and you don't have that much time, or you just don't want to see the fluctuation in your funds, talk to me. We can put some protections in place where you can still get a good amount of that upside or have some downside protection. I got you. But for the systematic investor, ride the wave, especially if you got time. If you're in your, I would say up to 50 years old, I would say up to 55. If you're up to 55 years old, well, I say 55 is probably the edge, right? Where you don't want to be riding too many waves. You 55 or more because you're right there on the age where you can start taking advantage of your funds. But I'll say 50. Let's say 50. Right? Well, I think 50 is safe. Ride the market. You can probably get your return. You probably get a return in your funds before you need the money, right? I hope that makes sense to you. And if it doesn't make sense, or you want more information about this, talk to a qualified investment professional like myself.